Rabobank's Agri-Commodity Markets Research Department has just released our 2019 outlook, looking at fresh, fundamental analysis and price forecasts for 2019. For wheat, 2018-19 marks the end of burdensomely heavy global stocks, as production prospects were pinched across several major exporters. Losses were felt across drought-hit Northern Europe and Eastern Australia, while Russian yields returned to average. As such, world stocks are forecast to be tightened significantly this season by over 20 million tonnes, which, along with shifting price dynamics and trade tensions, spells a less predictable 2019-20 outlook for global wheat prices. For the new 2019-20 season, Rabobank forecasts prices to remain elevated in the short term, with 12-month downside. This longer-term weakness comes as strong US and EU prices encourage additional plantings. We see EU harvested area expanding by around 500,000 acres year on year in 2019-20. When accounting for trend yields, this will drive 150 tonnes in EU output, up 10% year on year. In Russia, Rabobank forecasts a 1% rise in 2019-20 acres. This will allow for marginally higher Russian exports, some 35 million tonnes. Russia is forecast to maintain export dominance amid ruble competitiveness and bar any unforeseen crop or logistical issues. And finally, the US. US new season wheat acres touch a 4-year high, with strong margins, particularly relative to soy and corn, driving growers to plant and to favour wheat. A potential emergence of El Niño, which often brings winter rainfall to the southern US, could favour the development of these acres. So, after 2 years of erosion, 2019-20 global wheat stocks are forecast to grow marginally. As such, Rabobank forecasts price pressure across both Matif and CBOT into late 2019. So corn. Well, CBOT corn prices have remained stubbornly low through 2018, despite tightening inventories across the US and the globe. The second consecutive year of tightening since record world stocks in 2017. CBOT corn is forecast to rise through 2019-20 as both global and US stocks are maintained at multi-year lows. With trade tensions, there are clear incentives for South American growers to favour soybeans, while US planted area, set to expand by over 3 million acres year on year, will not be enough to offset these acreage losses elsewhere. So, this all spells a third year of global supply deficit, drawing global 2019-20 stocks to use to just 11%. On the demand side, global demand is expected to mediate to unchanged year on year in 2019-20, as a recovery in global wheat production and other feed grains lessens the requirement of corn for feeding. So as such, Rabobank forecasts CBOT corn to rise through 2019 in line with eroding global stocks and lower supply availability.